Welcome to the Dividend Talk podcast, episode 75. What we do when the market tanks. Hey everybody, welcome back to another episode of Dividend Talk. In today's episode, we're going to talk a little bit about Philips, a little bit about why the oil prices tanked, and pretty much what we do when the market drops or dips or dips below a certain point. All that and more. See you on the inside. Good evening, European DJI. How are you this wonderful weekend?
I'm doing really well because I bought some shares today. It was a brilliant opportunity. I think we have the topic of today also aligned to that, so I feel really well about that. Other than that, it becomes a bit repetitive, right? I was just really busy at work. It continues to be busy. It seems that the inflation is not only in our costs, but also in the workload. But I believe you have something similar at the moment.
Yeah, inflation in the workload is horrendous. But hey, look, everybody probably suffers from that same problem at the moment, so I can't complain. But hey, let's jump in. We got a few bits of news. There's been lots of happening in the market. Twitter's blowing up and social media's blowing up. So, but we might talk a little bit about Philips. I know we had some older news there recently that you discussed, and you have some continuation on from that.
Yeah. So a while ago there was this voluntary recall of their respirators, and actually not this week, but the week before. So last week they give an update. The Philips is a company, and what's really interesting, and this was on the 14th of November, the share price tanked just after that. So just for the listeners, the stock started the year with trading around 43 euro or something like that. I saw a peak around April, May of 50 euro. And today it is trading at around 30 to 33 euro, which is really already a drop of 24%. And a lot has to do with the respirators and the faulty issues that were discovered in the United States. And, honestly, there was not so much new in the news on the 14th. It was more like a response to the FDA findings, which are serious for a company like Philips. Philips went into a medtech company, so it's spun off all the other legacy businesses. So this is their core business now, and this is the risk really what you see at such companies like any pharmaceutical, but also a company like Medtronic. And I find it honestly really poor how the CEO is dealing with all this stuff. We see this a lot, that American regulators are quite tough. And I don't have a feeling that they are tougher towards European companies. I see the same zero tolerance towards American companies. Let's take the Johnson & Johnson case again, how they are dealing with the talc powder issues. They just spin it off into another legal entity and declare it bankrupt. Philips cannot, of course, do this. These claims are not there yet as such. Yeah. But if you then see what's happening to the stock and how European CEOs and management boards tend to respond to this, I find it really poor. I find it always a little bit in denial. It isn't honest kind of feeling. And it's a pity because Philips is really losing reputation now in the United States. And I hope they will really get their act together, fix this quickly, satisfy the FDA, make sure that the products are well designed, well functioning, and move on. I think it's too early for them to be able to move on. But the stock just keeps on tanking. And also today, on such a day like today, it's also one of those stocks that is, responding with the market going down. And I just wish that it will go a bit better going forward going to Philips. They have kind of a history with poor management since they have this CEO Van Houten. I do believe that Philips is entering value zone now. my fair price is around 33 euros. So let's say they are fairly priced now, but I would like to see a margin of safety. So if it hits like the 27 euros, I will buy some. I bought already an initial position at 39, but it was really just few shares so that I could start monitoring it. So it still needs to go down for me 20%. I'm having an eye on it. But these European boards and management teams, like we have enough of them. Also, like Bayer, it's just killing me how they deal with these kinds of situations.
Is it a little bit of naivety maybe on some of the CEOs' part, not being as streetwise? Like, surely they know these problems are going to come up and they can't just sweep them under the carpet.
Yeah, I think so. I think so. Maybe this is what they should start teaching at business school, how to deal with litigations and such, or product defaults, even if you feel it's unfair.
Yeah, yeah. And are the rules different in Europe than in the US?
Uh, I have a feeling that in America, the rules are not so much different. They're just more tougher in execution. I think there's too much politics involved in Europe and too much protectionism typically.
Yeah,
I mean, why does this pop up in the United States again, and why not in Europe? Is it
that
that Europe is not checking? Is
yeah,
that it? I have no clue.
yeah.
Yeah,
That's
why
what I
why
would.
why why has Dieselgate been found in America? Why was Volkswagen severely punished in America? Why not in Europe?
Yeah. See, some of these companies that just talk about are the darling companies of Europe. They're pretty big brands in Europe. You go across to America and you're not a big brand. You're not a household name in America, so you have to play by the rules. And maybe they just are used to getting their own way in Europe, and it just
Yeah.
doesn't fly like that across the
Yeah,
pond.
and we see Johnson Johnson is a household brand there, and it also cannot,
Yeah,
shy away from this. So, yeah.
yeah, interesting. So I was having a look today at the news after you wrote to me and said the market is going bananas. And to be honest, when I first read this, I read it wrong. I thought oil tanked to $10 a barrel, and I was like, the world is gone absolutely crazy if that's happened. It didn't. It only dropped 10%, so it went down to, I don't know, 75 or $76. So when I saw it first, I I read it wrong and I was like, oh my God, like we only got wind of this new virus or strain or whatever it is that they're calling it, and people just panicked. But there's still panic in the markets, isn't it? I cannot believe we're 75 episodes in, and I cannot remember an episode where COVID hasn't even been a small part of a topic in it. Like, it's absolutely bananas
Yeah.
what's going on. It's crazy. And when will it stop?
Once we have the virus gone, I guess. So this has to do with the South African mutation that they found,
Yeah.
which might be more contagious, or the vaccines might not fully work against it. It's really simple. What have we been seeing over the last few months? Supply issues. Yeah, increased demand everywhere. Let's not forget, people that are going to work nowadays are using the car more because they are afraid to go with public transport because there are too many people there. So
Yes.
there's a lot of oil demand. And also, by the way, airlines started to operate a bit more properly again. So I think we know now there's a floor here when it comes to this. And even if we would go back into lockdowns, it might indeed, let the oil tank temporarily. But these oil companies are so well positioned at the moment, because I think the behavior change that we have seen, that people will stay more on distant and use more their own transport than public transport, is there to stay for many years, I think.
Yeah.
So, I mean, I see this as opportunities. I'm already heavy in oil, right? But if Shell goes back to 10 euro, I mean, I will do lots of ops. I will buy a lot of call options again, like I did last time, because they did me really well.
Yeah.
And I see this as an opportunity. I don't see this behavior change. A lockdown will be something temporarily.
Yeah. So look, speaking of that, speaking of lockdowns, the market tanks, the market falls 20-30%. What is European DJI going to do?
Well, buy. So I'm typically not selling. Yeah. So this is probably a good question indeed regarding to the main topic. Um, what I learned now, right? So my experience as a dividend growth investor using large sums of money, right? Not talking about 10 years ago when I was playing with 10 euro here and there. But with a decent portfolio, I experienced two crashes. One was the oil price crash in 2016, which brought a large part of the market down, specifically in the energy sector, and then, of course, last year during the pandemic. Um, what I've what I've learned from myself is that I tend to be an early buyer, because on days like today, I typically buy something. We're still around all-time highs, right? So what has it really tanked? But usually they pop up some opportunities because there are always some stocks that are, let's say, on my radar, but then when they drop 4 or 5%, they become really interesting for me, right? Yeah, so I tend to be an early buyer in the beginning, within the first 10% of a market drop. And then usually after that, it shakes out a lot of people. And what we've seen over the years, like we have these 10% dips like once, twice, 3 times a year. So I see them as buy the dip opportunities. And we don't know yet whether it will go down further. Because every time when the 10% dips, we see on CNBC and those financial gurus saying like, oh, the world is going down. Yeah. And it's just the narrative of the day. And quick, and I wouldn't be surprised if in 2 3 days we will be back to normal. Yeah, and then we forgot already about this price action today. So in that case, it would have been a buy the dip, and that's kind of my mindset at the moment. However, those other 2 times, it kept on tanking, right? And the news went only more severe. And I remember that it was specifically, I think, during the pandemic, that it was in the weekend. So that's where I really start to shift in other gears, and then comes my how is it my my financial crisis plan into place. And that's where I, for instance, don't buy one more than once a week. I put this as a fail safe mechanism for my own stupidity in here, because if I start buying more than once a week, I don't know what the prices will be doing, and what it will go further. And I have seen, for instance, in the pandemic last year as well, I was also there an early buyer. So I've got few things. I buy then afterwards every bracket of 5% more down. So let's say 15%, 20%, 25, and maximum once a week. But I do spend much more than I would do in regular times, because I've got some money at the sidelines typically.
Yeah.
I want to be fully invested, but somehow I'm not able to do that here, because there's always some money somewhere coming in that I don't spend straight away. Um, so it's like, in brackets of 5% drop, and I look here at an index, not at individual stocks, at an S&P 500 index, and then once a week. Um, but also in the first 10%, I don't spend more than twice my monthly, how is it, investments as
Yeah.
well. Yeah, so I don't want to overinvest in a dip as well. Um, so this is more my behavior there. It works for me. I'm really strict on myself here, because otherwise I would just buy everything on impulse. And this is the main thing that I've learned. I need to have a system in place that prevents me from being impulsive.
Yeah.
And that's kind of the rules that I live with. Um, One more thing as well, what you will see during regular times, I might sometimes be more in high yield stocks or something like that, specifically now when everything feels so expensive. When there's a crash, I focus on high quality companies. I go back to my top 10, and those I want to give priority over anything else. Because in my tier one companies, we have the Johnson & Johnson, 3M, PepsiCo, all the big ones, Microsoft as well, Apple. I want those during a crash, because they're usually not available for me really with their yields and such, and with their pricing. All the other ones in the tier 3, tier 4 zones, I can usually buy also like in regular times,
Hmm.
because they are of different natures,
Yeah.
sometimes high yield, low growth and such. So I really focus on quality companies. As an example, Johnson Johnson is now on 160, but consider me a buyer at 145. Still means a 10% drop, But that's what we're talking about, right? When there is a crash. And during the pandemic, I had the fortune to buy Johnson Johnson at $115. That was almost at the bottom, and I straight away bought quite a good slice of it. So here as well, these are the times you can really focus on quality, because what happens during a crash, right? People get nervous. They're not necessarily willing to sell Johnson Johnson, because most, I said, investors hold on to Johnson Johnson.
Yeah.
But it's index selling what is happening. People are massively selling indexes, and Johnson Johnson is part of almost every index. So the quality is there, the earnings power is there, but you have this really nice situation that you can buy these shares cheaper. On the other end, that's why they are always so expensive, because people are not buying Johnson Johnson individually, they're buying indexes.
Yeah.
And with that, it props up the prices like companies like Johnson Johnson. So yeah, that's a little bit my playbook for when a market really tanks EMF.
Yeah, and it's really good to hear. I mean, I've only had experience to one crash, which was the COVID pandemic one, and I don't have set rules like you. I know you have more experience. You've been through it, and I think it's really interesting that you have rules in place to stop you from impulse buying, because that is probably something that I would 100% do, because you see so many companies drop and you want so many companies
Yeah,
that it is easy to go, okay, buy. And as you said, we don't know if this market drop at the moment is going to keep dropping further. I mean, we say it's a market drop. It's dropped, I don't know what, couple of percent. What was it, 5-6%, maybe 2 or 3%
yeah,
today it dropped.
yeah, exactly.
It's still much higher than it was in October, the very 1st of October. So
Exactly,
I mean,
exactly.
you gotta look at it in
At the
perspective
big
here.
picture.
You
Yeah,
have to look at it at the big picture. I didn't even know that the market was down in any way, shape, or form today. I think you wrote to me a couple of hours ago and said, "Would we talk about this?" And I was like, "Oh, I didn't know it happened." So I quickly went online. I seen Twitter. I seen people panicking, people giving the same advice, buy the dip, and all this sorts of carry
yeah.
on. I'm a dividend growth investor. I don't need to be checking my portfolio every single day. Is it up? Is it down? And actually, after you text me, I did two things. I checked the Gyro account, which is my dividend account, and I didn't even check. So at the top of on the app, it gives you your balance. I don't even look at that. I have it hidden. I just click look for the dividends. What did I receive today? I then went into my interactive brokers account. Now this is my option trading account, and I have a different feeling with that. There, I'm more concerned. Actually, I looked at it and went, "Oh my God, I'm down X amount," and it just hit me differently. But when I compare them, if I was to compare the dollar value or euro value that I was down on both, I'm down a lot more on my dividend growth account, and I didn't care. It doesn't bother me. But I'm down a lot more on the option or the trading account, and now I'm thinking, oh man, am I overextended? Uh, am I doing things right? And it's a different feeling. So personally, for me, and this probably applies, if when you get that feeling from an account, from growth trading or growth stocks, whatever, you're probably overextended too much. And I did overextend myself a little bit this week, because we had that news on Visa
Hmm.
where they dropped, and I fully expected them to come back. So I bought options on them, which holds up. I don't know, what did they trade at, 180 or something. So it holds up nearly 20 grand, say. So I bought options on them. They did bounce back up. My plan was to get out today, but when I went back in today, they dropped. So I'm going to hold them a little bit longer. And I also bought Alibaba, puts on Alibaba as well. So I have two kind of larger positions than what I would normally have. And it just so happens the market, the tanks. Now I'm okay, because they're cash secured puts. If I do get now, and they're long dates, I think they're sometime next year. So it's not as if I'm going to get a sign straight away, but it still hit me differently than what it did in my dividend growth account.
Yeah, and I can imagine. And we do this show also today more to to be early with this before fear really hits the market, so we can
Yeah,
share our knowledge and experience here, right? So I still see this a bit as a dip. Here
yeah.
we've seen this few more times also with the China risk that we had a few weeks ago. But I fully understand what you mean, because last year during the pandemic, I had some ExxonMobil puts
Mm.
sold. I think at $60 or $50, and then the share price went to $35. Suddenly, you're like 1,500 euro in the minus plus the margin on top
Yeah,
of it, right? So that's why I usually have like one or two options that I
yeah,
sell. It gives me like $100 a month or $150 a month, and that's it. Which means that I have really little exposure to options. But I can imagine you're much more option trading here, and then the volatility here increases the beta, and I sit in the option price, let's say.
yeah.
So yeah, and then your problem might be that you get margin calls at a certain moment, right? If you go too deep in the red.
Yeah,
Yeah.
and that's true. But as I said, they are cash secured, so
Okay. Yeah. Yeah.
it is conservative. So I
Mm-hmm.
don't use margin. I
Mm-hmm.
don't overextend myself that much. But what that would mean maybe is this month, instead of buying dividend stocks, I will just keep that cash aside just in case in there.
Yeah.
So there's obviously opportunity cost missed, or there's other things I can miss out on.
Mm-hmm.
Um, I only did those option trades on Monday, maybe. So if I had a, and it was late, I think it was like 2 minutes before the market closed. I only got home from work. I hadn't planned,
Yeah.
but if I hadn't missed it, I wouldn't have had a chance to do it all week. So maybe
Yeah.
I should have waited 2 minutes. But it's just interesting for me to see both sides and have contrasting feelings based on portfolios. And honestly, I think the best thing that anyone can do is not panic whatsoever. I mean, we said this the last time, and you'll see lots of people say this right now when it's a small dip. You will see lots of people say this. 100% you will buy the dip. It's a buying opportunity. I don't necessarily think, I mean, I don't know what the difference is buying a company now then at the start of October, considering that we're still ahead of
Yeah,
that.
but
Do you get me?
it's not a stock market, right? It's a
Yeah,
market of stocks. So there are companies that were trading yesterday lower than in the beginning of October, and they
yeah,
dropped now by this 5% or something like that into value zone. Yeah, but for me, still 95% of the market is not interesting for me. They're still overvalued.
exactly. Heavily overvalued. And we've been asking for a stock market crash 75 episodes now. So
Yeah, exactly.
I kind of want one because I'd be excited. I'd like to load up, and as you said, some of the companies that I don't necessarily get an opportunity to buy in bulk. I'd like to buy some companies like Texas Instruments, for example, in
Oh,
bulk.
yes, exactly.
I don't get that opportunity. So obviously you can buy the lower end companies, but I'd like to buy the Microsofts and Texas Instruments. I'd like to
Yes.
start being able to pick those up cheap.
Yeah. And did you sell something during the pandemic last year?
No. Well,
No.
I didn't. I think I spoke about how I was changing my portfolio, but I didn't sell anything based on stock prices dropping. I was selling shit companies to change my portfolio into what it is now.
Yeah. So what I last year, of course, sold was Disney, but that was driven by the dividend cut.
Yeah, yeah,
So it was not driven by share prices tanking. So the only reason why I would sell is really when a company cuts the dividend, and I don't automatically sell. I still look at
yeah,
what the opportunity still there is. So that's why I didn't sell Shell last year, but I did also sell AT&T, right, when they announced the spin-off, which was effectively coming with a dividend cut. So for me, a dividend cut is way more a reason to sell, and it's just simply a fact that more dividend cuts happen during a stock market crash, because then that's when the companies get liquidity issues.
yeah.
But my portfolio is designed to catch that, right? So, and I'm way more better diversified than when we went into the pandemic in March 2020. I was really dominated with my portfolio on energy, and I really used last year to diversify my portfolio. So I feel so much more comfortable now with my holdings.
Yeah, but I think the key point you make there is you did not sell because of price depreciation.
Exactly,
You sold
exactly.
because the company's fundamentals have changed, and that's completely separate.
Exactly, exactly. And this is what a crash can do specifically for companies in the blast zone. And Disney was in the blast zone because
Mm.
they had to close all the parks and everything. So they
Yeah,
had to preserve cash, and at the
yeah.
same time, they are in an extreme war with Netflix on the digital streaming. So yeah,
And look, we both sold Disney, and Disney's price went up nearly double, I think. And we've been asked over and over, and none of us have ever regretted it because we sold for a different reason than share price.
yeah.
If we were to sell that basically because the share price was going to tank, or it tanked, and then seeing that price grow to double, as an investor, you're going to go, "Oh man, I made the wrong choice." But I still think I made the right choice with Disney.
Well, even from a share price point of view, the share price from Disney, I think, went almost to 200. It's now
Yeah.
around what, 140, 150.
Oh, it's
So
after
it,
coming
it,
back
it
down.
tanked quite a bit. Yeah, yeah. But I bought Chubb at the time for $100, and I sold Disney for $100, and Chubb is now at 188. So even from a price appreciation, I bought just a really boring insurance company, and it still outperformed Disney by a mile. If we take the share price from today, at least.
Yeah, and you get a dividend on top.
Exactly.
Cool. I think this is a really nice topic. I think that a lot of people will panic or start to panic as price action goes on. I just think it's really important to stay calm, turn off the news, turn off Twitter, just step away if you start feeling like that. And honestly, if you get to a point where you think that you're going to lose everything, maybe you need to look at your risk. You know how you view your risk tolerance and how you're allocating, because if you're going to be worrying about it, maybe that money should be somewhere else.
Yes. And of course, we're not giving financial advice,
No.
right? But still, we're doing it in case you're listening. Fuck those legal things. Come on, it's hypocrite, right?
Perfect. So with that, we might move on to some listeners' questions.
Yeah, the first one is from Phil, and he's asking us, can we have a look at each other's portfolio and recommend to each other which stock or which position would we sell?
That is a fantastic question, and I'm looking at European DJI's portfolio, and I'm really struggling. There was two that I might pick, and one of them was ExxonMobil, purely because I know you spoke about them before, but the other one that I would have picked would have been Hershey's. So that's ticker H. Where's it gone?
HSY to help you.
HSY. Yes, I couldn't
Yeah.
find it. I couldn't find it. Ticker HSY, Hershey. And the reason being is I don't know a whole lot about this company other than that they make bars of chocolate that I see, like this one bar of chocolate. And that's probably why I sell them. I don't know how much moat they have. Their share price looks overextended. They're trading at a high multiple. So if I was to pick one in your portfolio, that would be the one I'd sell.
So I'm so glad that you don't manage my portfolio because this is one of the highest quality companies that you can imagine in the
Yeah.
world. And what I really like about it, it is like Fresenius, it is having an ownership by a kind of an NGO, which the founder did to protect Hershey from being taken over.
Yeah.
So this is a dividend growth company like a kind of a Johnson Johnson. It's true that it's overvalued, but this is where I always say let your winners right. But with ExxonMobil, I fully agree with you. I want to exchange it for Total Energies. I still didn't do it. Hopefully, I can do something before the end of the year to do some tax harvesting to compensate for my option profits. But good one, thank you. The first one I will take into consideration. The second one,
I
do
know.
your
I
do
know.
your homework. So
You have to look at my portfolio now.
yes, exactly, and honestly, you have a really solid portfolio. I can really see the cleanup that you have been doing. So if people want to see your portfolio, they should go to engineermyfreedom.com. And based on that, go to the tab My Portfolio, and you will be able to see his portfolio. And you have a rock solid portfolio. And I must say that I like a lot of those. You've got literally all the dividend kings in there, the American dividend aristocrats. But if there's one that I would have the most doubt about is Verizon. I know it gives a lofty dividend yield. I just see it as a capital intensive business with a lot of competition, also around 5G.
Yeah.
And I don't know how the telecommunications sector will evolve over the next decade. Are these assets really going to generate so much cash? I always have a feeling that companies like AT&T and Verizon are making these really expensive acquisitions because they need to do something, and they overpay typically for it. And we've seen that with AT&T as a classic example. But the main beneficiaries from 5G will be the companies that build a business model around it using the technology,
Yeah.
and not the infrastructure provider like Verizon. So I'm not living in America, so I don't know what the branding really is of Verizon, but that would be my pick. Other than that, you have a really solid portfolio here. Yeah, and I wouldn't sell anything else. Probably I wouldn't
Yeah.
even sell Verizon in your case. So
I was looking at selling them. I think I show the value of my portfolio as well, I believe. So they are quite small. It's tiny. It's like I think I own 10 shares, and I was buying it at the beginning of my portfolio, and it was, I held on to it for a while, but honestly, I don't see much need for it. I much prefer Orange, the European company, in that, not as a long term play. I think I've made that clear. Orange is a short term play, maybe 3 to 5 years, and then I'll sell if it doesn't work out. But Verizon, it's just there by default. I probably won't keep it any much longer. Uh, I'd probably sell it and buy something in Europe, but I don't know. It's always been there. I think it's been there since near the start of my portfolio. So
well, you know what they say. It's best to not make any trades for a portfolio usually, and treat it as a coffee can. So
yeah,
good. Thanks, Phil. That was a really interesting question. It didn't create a conflict, if that was your intention.
yeah.
But thanks for the question. So the next
Okay.
question is from Centrino, and he's asking, like, he understood that I'm generally buying once a month. And he's asking, do I do this on a fixed date, like the first day of the month, or do I only buy if a price drops to a buy target? So I rather buy something when a price drops for a company on my watch list that reaches a buy target, because I have this value investing mindset as well in my head.
Mhm.
But for instance, today I had to buy something because November is ending, and I didn't buy anything really in November other than few shares of Alibaba, but no dividend stock yet. So yes, I still push myself to buy something in the given month and to not lose the opportunity, because otherwise I will find myself what I did in 2017, that I start hoarding cash and then lose out on a lot of opportunity actually that I had. So I do force myself to really look into companies and make sure I buy something every month. And I'm of the philosophy that I can't imagine that out of, let's say, 20,000 stocks in Europe and America together, that there's not a single dividend growth stock that is attractively valued for me at that moment in time, even though I have my 40 stocks on a wish list.
Good. That's good. Martin has asked us, Siemens has increased our growth prospects and share price this year. Any updates on our fair valuation estimates since we last discussed the company on the podcast?
Yes, I don't have the numbers in front of me, Maarten, but I do believe the company is in a better position than last year. They have been increasing their backlog from what I remember when I last looked into it. I also, you know, what was happening in Glasgow and such, also looking at the competitions like General Electric that is struggling, I find Siemens just increasing their quality every time when I look into them. Also, again, with the latest quarterly earnings, I think we touched upon them in the show here.
Yeah.
It's really impressive what the company is doing. It is cyclical. We saw that today. I think they dropped 5 or 6%. So these are not the times for me to buy. last year they went all the way to the low 70s. I would consider myself a buyer now when they go to the low hundreds. It is probably even a little bit below fair value then at that time, but I just believe that it's high quality. So yes, my fair value estimates are much more positive than they were last year, based on the company's performance.
Good.
Okay, so then the next question is from Basque in Sweden. So I believe that's a Spanish guy living in Sweden. And he asks us, what do we think about TUI? And for the people that don't know TUI, specifically for the American listeners, this is a travel agency over here in Europe. And he's asking, will they survive another round of restrictions and lockdowns this winter?
Well, I fucking hope so, because I only booked a holiday with them a couple of weeks ago for next year, so they better stick around. Oh man, I hope they're not in trouble. I could see why they might struggle, but hopefully restrictions won't be as bad, and they'll stick around. I've never actually
Yeah.
looked into the company as a stock or the financials, but I always use them when we're traveling. So maybe that's a lesson. Maybe I should look into a company like that before booking with him to see if my money is in danger. Because I paid in full. I paid everything up front as well, which is probably stupid.
Well, stupidity here you will only figure out afterwards.
Thanks.
Good. The next question is from Dermot. And thank you, Dermot, also for the kind words that you're sharing with us. And he is asking whether we have any Irish companies on our watch lists. I believe even you have one in your portfolio, right?
Yeah, I have, and Dermot will know the company. I have Glambia in my portfolio, which I think is a really good dividend stock, by the way. And they have a nice yield, low payout ratio, and they increase it every year. And another company, and I think you looked at these before as well, is the packaging company called Smurfit Kappa. So their ticker, you'll get them on the London Stock Exchange, or you'll get them on the Irish Stock Exchange, but the ticker is SKG. And I think, look, they're a really, really nice company, strong company. They did cut their dividend before, but that was back in the last crash. I think they're in a much better position now. So you will get some price appreciation, you will get some dividends, and they're two nice companies. So Dermot, check both of those out. Actually, I have a blog post called the Irish Five. I have 5 companies from Ireland that pay dividends, if that's what you're interested in.
Cool. Thank you. Then Bas Erlings is asking whether we park our war chest in a widespread ETF or just in cash, especially if you believe that time in the market beats timing the market. The first option must give better returns. Well, Bas, here's where I'm not so smart because I have it just on cash on a bank account. Why is this? I think it's a bit of laziness. I'm focused mainly on managing my portfolio, not necessarily putting my cash into ETFs, but you do trigger a good thought. So I should look into this. But if it would be an ETF, it wouldn't be so much a widespread ETF. It would rather be then an ETF focused on a bit of yield, let's say, but where kind of the capital is preserved
Yeah.
here.
Yeah, I mean it's a fantastic point, and it makes complete sense that you would do that. I mean, as you said, time in the market beats time in the market, so it makes sense. But you also want to make sure, as you said, and it has to be easily accessible, because you
Yeah.
use that money to as your war chest, use it to buy, so you want to be able to quickly move it around. So there's lots to consider.
But be fair, I want to get rid of my war chest. My war chest is just something historical, and what I struggle with is to deploy extra money into the stock market during good times because the stock market feels so expensive. And I was thinking about this a lot actually this week, because when I heard the inflation numbers are 6 or 8%, I'm thinking like, shit, my war chest is devalued by 6 to 8%. Yeah, but how long can you wait for a crash? I can wait another 5 years and nothing happens, right? So
Mm.
there's a lot of opportunity cost involved here, and I'm sure I lost money on my war chest because of the opportunity costs.
Yeah,
So that's why I believe it's better to be fully invested and just have how you say it, just have an emergency fund ready that you might want to pull from even during good opportunities. I think that would have done me better over the last 5 years than having a war chest, even though the war chest was unintentionally, because I had a bit of a windfall once after selling a flat with some overvalue, and I put that as a war chest. So I should have just invested it if I would have made the choice again
Yeah.
at that time.
Cool. The runner has asked us, what is the difference between investing for dividends compared to capital appreciation, and why should you favor dividends over capital appreciation? And I think, as we said, it depends on your goals, depends on what type of investor you are and what you want to do. Dividend investors typically invest for income. We want to live off that income. Capital appreciation investors, they want to make as much money, maybe grow their net worth, and then you have to sell that at some point to live off if you want. But look, they're two completely different styles. It's just what you want to do as an individual will depend on which one you choose.
And what I would like to add here as well, I went for a drink this week with a Dutch guy that visited Warsaw. So we spoke a little bit about this as well. And what I would like to clarify that many people might not be aware, specifically from the Netherlands. In the Netherlands, they have wealth tax, so you don't get taxed on capital appreciation, but you do get taxed on dividends. So in the Netherlands, typically you can better buy, for instance, an ETF, a capital appreciating ETF. You wait, for instance, until you accumulated 1 million, you sell it. There's no tax implication on selling it. And then you buy dividend stocks and live off the passive income. But in the accumulation phase, if you don't pay tax for capital gains, but you do pay tax for dividends, it might be way more interesting to buy some more growth stocks, grow the capital, because in the end, for instance, let's say my Microsoft, it went almost tenfold. If I would sell now, I would need to pay a lot to the tax office, really a lot. You don't have this situation in the Netherlands. So also based on your tax system, you might actually prefer in the accumulation phase rather to focus on capital gains. And then once you reach that threshold that you know on 3% of dividend income you could live, you transfer your portfolio into dividend or passive income generating assets, let's say, because the wealth tax they will need to pay anyway on whatever whatever their total wealth is. So I wanted to add this here as well because I do think it matters a lot in decisions you make when it comes to seeking early retirement via passive income.
Right. Good point. And if you don't pay tax on capital appreciation, then maybe that might make sense. But I know from an Irish perspective, you're caught either way. You're taxed on both. So
yeah, it's the same in Poland, both 19%. So yeah.
cool. So we have another question from Vedit something. I can't pronounce that. Sorry. Art. He has asked. He's from Sweden. Do you have any Swedish dividend stocks on your watch list?
Castellum, 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 Castellum. Please come to 200 Swedish crowns and you're mine, baby. I want this real estate company. I love this one. It's a cash machine. It's doing everything right. It has high quality assets. Via takeovers, it's typically growing. It just all the time hoovers or falls back to like 210. But please come to the 200 and you're my baby. Come on. That's it's one of the nicest, if not the best real estate company for me in entire of Europe.
No, there is an endorsement.
We don't give financial advice.
And with that, that is all the questions. There've been some really good questions. Thanks a million, guys. And speaking of financial advice, we are going to give our stock pick of the week.
Yes, it's actually really simple because it related to a buy I made today. So I bought Fresenius today. So not Fresenius Medical Care, but Fresenius itself. They originate from the same roots, these two companies. These are German healthcare companies. Fresenius is known as a hospital operator in Germany and Spain. But what I really like about it is that they are diversifying away also into biosimilars. And we know that biosimilars are not easy to produce. But did you know that they own a biosimilar that is targeting Humira from AbbVie?
Hmm.
So if this will get successful and it will really be challenging AbbVie, then I'm taking the money that my shares of AbbVie are losing. I'm getting them in Fresenius, and
Yeah,
this thought I love. I know that this biosimilar has not so much market potential like what Humira has. There will be probably 2 or 3 other biosimilars,
yeah,
but the company is now trading at 34 euro. My fair value estimate is around 43 euros. So it went below the 20% margin of safety today. So I decided to initiate a position. It has 29 years of dividend history, pure growth, not even a single year of flat, if I remember correctly. It has a dividend yield of 2.6% right now. It's under my 2.75% typical requirement. But here I was a little bit more, let's say, flexible because they only pay out like 20 or 30% of their dividends. And at the same time, there's a new dividend hike coming up in February or something like that. So I think it will meet my 2.75% criteria by then. But the PE is around 11, the forward PE around 10, price to free cash flow is around 5. So these multiples are really, really low. Some risks here, I think, with COVID, there's a heavy impact on the cash flow potential when hospitals are closed. It's just harder to treat patients. Secondly, if you look at, let's say, the value metric, which I consider like you have the cost of capital and the return on capital,
yeah.
it has not been really positive. It is hovering around zero. So effectively, they don't generate value with the investments they are making right now. Yeah, and this is, I think, important to know that there's a reason why the stock is down as well. Cash flow wise, really doing well, but from the investments they make, they haven't seen the return yet. So maybe if the biosimilar starts to pick up, that we will see the return on capital go up. I will be monitoring this, um, but I hope that it will do a little bit better going forward on this metric. So it's not a company that comes without risk. That's why I have a 20% margin of safety on this one.
Nice pick. And we do have an episode, don't we, with yourself and Phil, where he talks about this company in detail. If you want to find out more about the company, I think they're a fantastic company as well. But that podcast or that episode is well worth to listen to.
Yeah. And I also did, I think, 2 weeks ago, full analysis on YouTube there as well. So we will put the link to the podcast, which I think is nicer probably for people because Phil is really, really knowledgeable about this company. We'll put it in the link of the in the description of here. And yeah, just reach out to Phil or me if you have any questions.
Sweet. Okay, and with that is now the end of the show. As always, thanks to everyone for sticking around with us this long. Questions were great, and I mean the stock pick. I was looking at those also. I didn't buy any, but they scream out to me as a company that is value at the moment. So yeah, nice.
Yeah, and before we really do the final call, remember on Facebook, it's growing. The Facebook page has now more than 600 likes, and that's amazing. A few months ago, or in October, we were around 200 or 300.
Yeah.
But also, don't forget to come to the Facebook group. We are having around 190 members there. It's really starting to become active. People are starting to ask questions, and the interaction is nice. And it's a lot of Europeans there as well. So don't forget to join us, engage with us. If you have any questions, you don't need to wait till the Friday show. You can post them there already, and I'm sure that someone will respond there.
Perfect. See you all next week.